Hi, everyone. I'm Sean Sidlaska, founder and CEO here at Tessara Wealth.
I'm Drew Hennessian, a lead planner here at Tessara Wealth.
We're preparing this video to go over our investment philosophy and want everyone to kind of understand how we think about investing your portfolios. We created our investment philosophy based off of four main pillars. The first one is global diversification. So we're not taking a big bet on any specific country or company. We want to spread your investments out across the whole world. We believe in passive investment management. We believe the market is pretty much efficient. We don't think that we're have some magical stock picking power. So we invest in diversified index funds. We try to keep your fees low. A lot of your investments will be in low-cost Vanguard funds, which have some of the lowest expense ratios in our industry. And then we also focus on tax minimization. We focus on the things that we can control, like the timing of taxes, how much do we sell in a certain portfolio to minimize taxes over not just this year, but in future years as well.
Yeah, so like Sean was saying, we want to be globally diversified. This is a chart that shows the percentage of total value of the publicly traded companies that each country around the world represents. As you can see, the US is two-thirds of that. A lot of that is driven by the massive explosion in the tech industry over the past couple of decades. But a country like Canada, 3%, one company like Apple is about the same size. All of that said, a lot of the investments are going to be focused in the US because that's where a lot of the world market cap is. However, we want to be invested throughout the world because we don't know where the growth is going to come from in the future. For instance, 2025 was a great year for the international markets. And because our portfolios are distributed internationally, they were a beneficiary of that last year. So we want to make sure that investments are spread out through these different markets throughout the world.
And if you think about just the equity side of your portfolio, it's like kind of split up into thirds. So like two-thirds US, one-third abroad. And we want exposure to countries like China, India, Brazil, these countries that have populations that are going from emerging markets to developed. And so those tend to grow a little bit faster than larger, more developed economies.
This is what's called an asset quilt. So each color represents a different type of company. The bright pink small cap, those are smaller publicly traded companies, EM, emerging markets. And each color is different. And as you can see, there's no one color that outperforms year after year. Some did really well in 2016. They're not the same ones that did really well in 2022 or 2025. And the idea here being that a blended portfolio that contains all of these asset classes is going to be more stable over time. It's never going to be the top performer because it has underperformers as a component, and it's never going to be the worst performer because it has the overperformers as a component. So we want to have a balanced allocation so that you're not fluctuating too much in any given year.
Yeah, I like to say that we like to swim in the middle. And this isn't exactly our portfolio mix, but this is just an equal weighted mix of all these different asset classes. And it's kind of fun to look at some of the, REITs was the worst, then it was the best, and then it was the worst. It's just so hard to predict what's going to do well. Cash was the top performer in 2018. So we want a mix of all these different asset classes, and we do in your portfolio.
This chart, the growth of a dollar, it shows the returns that you would get if you invested a dollar in these various assets. So you can see the best performing asset on this chart is small company investments, small caps, then other equities, large caps, bonds are going to be lower performing and more stable. And you can see the orange being inflation. So what this is showing is a couple things. One is that if you want to beat inflation, you really need to be invested in the market, in equities and fixed income, stocks and bonds. And another thing is that the more you are exposed to equities, the more volatile, the bigger swings your portfolio is going to have. And you have to be ready for those to happen when you're investing for the long term. But if you want to beat inflation and really grow your wealth over time, investing in those volatile assets is necessary.
Yeah, investing in equities That's the primary driver of long-term growth. And like Drew was saying, these have like from peak to trough, peak to trough. This is the dot-com bubble bursting. This is the Great Recession. You want to have some bonds to help smooth out the ride.
Getting to another one of our pillars, passive management versus active. What this is showing is mutual fund performance. Those are active funds where highly paid managers on Wall Street are trying to pick the winners and losers in the market, trying to outperform a benchmark. And you can see that over the course of 20 years, only 18% of these actively managed mutual funds beat the market consistently over the course of 25 years. Only 46%, less than half, were even in existence two decades later. Sometimes they'll close up a shop, a mutual fund that has underperformed, and they'll reopen it under a new name with the same manager. And so that's why you really want to track who's surviving and not just a 5 year performance because they might have reopened since the last downturn. And you can see the longevity and the success rate are really poor compared to just tracking a passive index over the same period of time.
Yeah, and I think most of our clients are on board with this philosophy, but this really hammers it home. Less than 1 in 5 of these funds outperform their benchmarks over a 20-year period, and that's net of fees. So it just shows the importance of keeping your fees low, not trying to pick the winners. And these are people with CFAs, armies of research analysts, and if they can't do it consistently, like how could an average investor try to do that? So this is where we try to focus on what we can control. And one of the things we can control is the taxes. I don't believe you can outperform the market, but I do think that there are things like tax loss harvesting, which this slide shows, that does add alpha to your returns. And what alpha is outperforming the benchmark. And so when we create a portfolio, it's about 10 to 12 exchange traded funds. And in this example, it's this Vanguard FTSE Emerging Markets Fund. It's got a really low cost expense ratio. Assume you invested at this part in the market, and if it drops, what you can do is you can sell that fund and buy something very similar. There's a rule that says you can't buy the exact same fund within 30 days, or it disqualifies this loss. But you can sell this FTSE one, buy this MSCI one. It's a different company that's managing the fund, a little bit different makeup of the investments, and you can write this loss off on your taxes. And we have seen this work for our clients very well. And you still maintain the same exposure to these emerging market companies, but it's just a great little tax trick. Historically, this has only been available to high net worth individuals, and they have an investment advisor that looks at the end of the year to see what happened throughout the year, and see if there's any funds that are at a loss that they can sell. This is dynamic and happens throughout the year. And based on research, this can add as much as 0.2 to 0.6% in after-tax returns annually. Another way that we utilize technology to manage your portfolios and to keep you invested based on your allocation and targets is we rebalance based off of drift. So what that means is if you have a 25% target and it goes up to 30%, it triggers a rebalance automatically. What this kind of forces you to do is to sell high and buy low. Typically, human nature is you think you're rational and you're gonna buy when things are cheap, but in actuality, that doesn't really happen very often. But this rebalancing based off of drift, make sure that you're kind of in line with your target. This can add as much as 0.35 to 0.44% in annual returns versus just buying and holding and not rebalancing. We like Betterment for the majority of our clients' accounts. I view Betterment as a tool to get market exposure and to do the tax loss harvesting, to do the automatic rebalancing. And their platform fees are very, very low. It's 0.12, and then they use really low cost ETFs, 0.05. I've seen some funds with expense ratios of 1 to 2% just for just for the expense ratio for managing that one fund that's part of your portfolio. So this is like rock bottom fees, and they do a really good job with the portfolio management that I just mentioned. They rebalance automatically. They do the tax loss harvesting, and we help our clients set up their allocations based off of the time horizon of their goals, and then we review the performance, review the allocations, and make sure that they are appropriate given your stage of life and what goals you have coming up.
Yeah, one of the goals that are common for our clients is the desire to retire or be financially independent, work optional as quickly as possible, or quicker than a traditional retirement age of 60 or 70. So one of the ways to save for that is to aggressively invest in the market with a 90% stock allocation. So this is an example of a custom Vanguard portfolio that we built at Betterment using all Vanguard funds. With very low expense ratios, the fund fees per year, as you can see, average out to that 0.05% Sean mentioned. And if you look at the allocation, international developed 27%, international emerging 9%, you can see that yeah, over a third of this is internationally focused, reflecting our global investment philosophy as well, with a smattering of bonds for that final 10% at the bottom. Sometimes goals are not as far off. So typically, if they're under 2 years out, we want to build up your cash reserves. But if they're 3 to 5 years away, you want to invest and take part in the market, but you don't want to be as exposed to those volatile ups and downs that the market can expose you to. So in that case, we typically recommend something like this portfolio, which is 40% stocks and 60% bonds. So you have much more of the stable growth from bonds and less of the volatile stocks and equities. However, over 5 years, it has averaged out to historically beat the interest rate that you'll get in a high yield savings account. So that's why we typically recommend setting these up for, say, a down payment where you know you want to buy a house, but you're not sure exactly when, or maybe an investment property or a around the world trip, things of that nature. This portfolio can be used for. And here again, average 1 year return for this portfolio, about 5%. Obviously, it can have negative returns as well. On average, there's a very good chance that your losses would be minimized in a down cycle, and on average, you'll end up with a better performance than you would have just saving in a savings account.
Yeah, we kind of think of this as like a extension of your emergency fund. You can liquidate it at any time, and the goal is to get a little bit higher returns than keeping your money in cash or a high yield savings.
This is a common way to invest in retirement accounts. This is what's called a glide path. So you may have seen this in your 401k or 403b, TSP, however your employer invests for retirement. They'll have a date, a target date associated with it. Or if you're saving for college, it'll have a target enrollment date for the child to start college. And that is, as you approach that date in the middle, it's going to gradually become more conservative and getting away from the equities and stocks and close more fixed income and bonds. So it's a more stable portfolio the closer you get to that date that you're either retiring or enrolling in college. And then protecting against inflation with short-term tips after that. And so this is a great way to invest in a retirement account because there are no tax impacts from the year-end trades in and out of the different positions that the fund will have to do. We don't recommend this inside of a taxable account because you're gonna end up with capital gains and other income that's taxed that you don't see the benefit of. You just get a kind of a surprise tax bill. But inside of a tax advantage account like a 401k, that's not a concern. So as long as expenses are low, these are good options to invest for retirement in your employer plan or in your 529 for your kids' college.
Yeah, one thing I hope you realize or can see through this is we look at what your goals are, and then that helps us determine how aggressive we want to be with your investment portfolios. Another thing we look at is if you think about all of your investments as one household portfolio. Drew was mentioning, your 401k plan. That's like these tax deferred accounts where you get a tax break by putting money in. But then when you take your money out, you get taxed at ordinary income rates. So it's as if you earn that money in that year. Tax exempt, this is money that doesn't get taxed again. So Roth accounts, HSA. You put money in, it grows and grows and grows, and you don't actually have to pay money on when you take it out. And then taxable accounts, these are things like a brokerage account, like say you move money from your checking account to a brokerage account, and then you invest in stocks and bonds and in individual index funds. You get taxed on dividends and interest and capital gains every year, so they're not really tax efficient. It is a good way to kind of build wealth as well. And so what we're doing is we're looking at trying to balance all three of these accounts. And what that does is when you get to retirement, you have different pools of money to pull from with different tax implications, and that'll give you more options when you do get to retirement. So thank you. I hope this was helpful. Let us know if you have any questions at your next meeting. And yeah, thanks for taking the time to watch.